to watch it back, you can do, and you'll receive it automatically once you've registered for this event. Anyway, you're very welcome along to this week's webinar. It is Tuesday, the 23rd of February, and the time is 12:15. I am Brenda Kelly. First of all, let's get on with the old risk warnings, because that's how it is. Do remember that spread betting and CFDs are leverage products and can result in losses that exceed initial deposits. LCG provides an execution-only service, and this presentation does not contain any investment advice or recommendation. We accept no responsibility for any use that can be made of any of these comments or resulting consequences. So please ensure you fully understand the risks involved and make sure to manage your exposure. LCG is authorised and regulated by the Financial Service or Conduct Authority, should I say. Okay, so moving swiftly along, a good reason to have that risk warning there at the moment is owing to the fact that I'm actually going to, wait for it, have a look at Euro Swiss today. And anyone who remembers this time last year would probably want to stay as well away from Euro Swiss as is ultimately possible. But we have had the SNB's Jordan speaking in Frankfurt today, and ultimately he is looking to, I suppose, preempt what's going to go on with the ECB, a similar sort of situation to this time last year. And one would expect, one would hope, that we're not going to see as much madness surrounding the Euro-Swiss pair. But obviously, the ECB policy is, as he said, of utmost interest to the Swiss, and ultimately he was prepared to intervene in FX markets if needed. So that is something to be very, very conscious of if you are intending to trade anything with Swiss as one of the crosses within it. Nevertheless, I've taken this sort of move here, and you can see the highs we would have reached there just at the beginning of this month, and we've come back down through the 100-day moving average. The next available support there would reside around the 109, and below that the 108.80. So there's still a good element of support there, and of course there is a good possibility that, given the current expectations as to what's going to happen, that there will be additional euro declines. But we have to be very conscious of the fact that if the S&P says it's going to intervene in FX markets, it more than likely will. Bear in mind that the last time that the peg was removed, that big shocking time this time last year, they had just come out and reinforced that floor. So, you know, do take what they say, not necessarily with a pinch of salt, but with certainly a great degree of caution. And if you are trading Euro Swiss, be conscious of that. With that in mind, anyway, you can see how we would have gone exceptionally overbought there at those levels at the beginning of the month, and we've come back in to this particular point. So really, you've got good support really from the 200-day moving average, and if it does come back down to there, you would expect to see an element of a bounce from that particular end of things. Moving in towards the hourly chart then. And you can see the effects that we've had over the last number of weeks and days. Ultimately, it has, just over the last few hours, should I said, fallen below those lovely 3 moving averages, but it is finding a certain amount of downside still to go, and a huge amount of momentum. We've got the RSI there at a 17.5, very, very, very oversold at the moment. So don't be surprised if we see a certain amount of intervention, and I suppose that will more than likely, as I said, in around that 200-day moving average, because you would expect to see a lot of sort of stops and orders in around that particular level. So just to remind where the 200-day is, it is there around the 108.30, and that rising trend line support from the 24th of the 4th of last year. So watching for that one and be conscious of it. Right, moving swiftly over to cable, which had a Boris style day yesterday. Good times were had, and of course there's lots of calls for it to go back down towards 135, even 130. I think Deutsche Bank has been calling for. What you have to look at on this weekly chart is the fact that, despite the fact that on the 13th of, well, I suppose beginning of last year, 2015, we would have gone really, really low in terms of how oversold the RSI is. We've gone a lot lower on the price today, and over the last week or so, RSI still not oversold, and certainly a degree of divergence there. Now, I'm not saying that we're not going to pop down through that 140 level, but I would maintain that if it does pop down through there, there is a lot of orders that will come up in around the 139.40-ish level. Of course, it can dip even lower, as you would have seen back at the height of everything just before the bull market in February of 2009. But nevertheless, that 140 floor is going to be quite heavily defended, I would expect. Straight on towards the daily chart. If I can just get this thing to not do that, I would love it. There we go. Excuse me, my cold. So we are capped at the moment, as you can see here, by this 50-day moving average, and any sort of rallies up to it have been met with a great degree of disdain. But again, you're seeing this divergence on this hourly chart, and there is a good, as I said, strong support there around the 140.60 level, which is a 7-year low, bear in mind. So watching for that one to break away, and of course if it does, we've got the 140 coming in behind that and the 139.40. So ultimately the downside at the moment, while the trend is definitely lower, the downside targets are not as great as the upside targets might be. And of course what might actually do this is some sort of weakness in the dollar, and of course that doesn't seem to be forthcoming at this moment in time. So the hourly chart, again, giving us an idea as to where we've gone and where we might actually go from here. And ultimately, while we're up around this 141 level, there is a propensity for us to go back up to that 142, which is your 50 hourly moving average, and that's the max bounce I would expect from this. So I'd be waiting for a recovery, to be honest with you, in the cable before I'd start looking at potential shorts in it, and those seem to be somewhat forthcoming. We've had a lot of data, well, sound bites from Mark Carney today, mainly surrounding monetary policy. And while he has said before that, you know, they would look and be cautious and keep an eye on things, he does sense that the next rate move is going to be up rather than down. But he said, why bother with rates? They might do some sort of more quantitative easing or buy other assets instead. So we might not be looking at negative interest rates here in the UK, but there might be some degree of stimulus forthcoming if this actual market continues to keep this this momentum to the downside. Now here's your hourly chart, as you can see, and I am taking this to, I suppose, a channel sort of scenario that we have here. And you can see we have actually fallen out of the base of this particular channel, having been in a massive old downtrend since these highs that we would have seen at the beginning of the month, and below all those three moving averages. So as I've said, there is this propensity for us to get back into that channel, retest that 50-hour moving average, and possibly even as far as the 142.50, which would, as you can see here, be a fairly decent resistance, having been support in the past. So that would be my level to watch, and clearly that represents something of a line in the sand for us going back up to test the top end of the channel. But as I said, the trend is down. We're looking to potentially sell any rallies that might occur, but the rally, I think, may not yet be over for now. So do keep an eye on it. And again, if we do drop back down through the 140 level, take advantage of that, certainly, but don't expect it to be a long-lasting scenario, certainly not in the very near term. When it does, I will have a word, I promise you. Moving swiftly over to the euro dollar, and what has been interesting about euro dollar in the last day or so has been the fact that we are back with parity calls. Deutsche Bank back with their parity call on the euro dollar, expecting it to break down through these lows that we would have seen back, I suppose, at the beginning of March of last year, and they're expecting that 104.20ish level to actually break now. And of course, you're testing this 50-day moving average, which was looking rather perky for a while, but certainly this trend resistance here at around the 113.30ish level has been a bridge too far on this weekly chart. And the weekly chart, very much the momentum starting to point to the downside, and certainly no sort of divergence giving us any idea that we might be moving higher from here. So a weekly close through that 50-day moving average would certainly put the kibosh in any additional upside. But you can see at the moment that we have fallen through the 200-day moving average, which should in itself provide an element of resistance. Now, that's what I've been reading in a few places, and what I will say that it has provided a certain amount of support and resistance over the last while. Don't depend on it too hugely. What I'm looking for at the moment is a potential return to the 108.90ish level, which would be your 100-day moving average, the green line that I have there. Here's my trend, and this is your daily chart. And that would somewhat coincide with that trend line support. And clearly, if that kind of breaks, we've got ourselves potentially coming back into this longer term trend to the downside. And this cross level here, that where these two trend lines cross, would, I suppose, mark the end of the idea of euro heading back up against the US dollar. Now, this depends a lot on this risk appetite in the equity markets continuing, because as we have noted over the last while, any sort of downside in equity markets has been to the benefit of the euro, and it has appreciated quite considerably as there's been a big rush into the German bonds and even some of the peripheral bonds as well in a flight to safety. But again, I'm going to point out the idea that we've got these three moving averages here coming close together. I don't know why I'm demonstrating with my hands, but they're coming close together, converging together, which, if the price action drops below it, would mean that we're in for something of an explosive move to the downside. So we have to watch that one quite carefully, definitely. But for the time being, I'm expecting that 110.40, 110.50 level to perhaps act as a bit of a restraint to upside if we do actually see any upside in the very near term. Now, here's our look at a little bit divergence on this one. You've got your hourly chart, and this could provide a better sort of, I suppose, sell zone if you are inclined to get involved in this euro-dollar pair. You can see that the RSI has made new lows yesterday, but the price action was not as low. Not as low today on the RSI, and yet we have the price action that bit lower. So potential for something of a little mini bounce in the offing from this one. So let's have a look at see where it might actually go. And I'm taking, and excuse my cold, I do apologize. I'm keeping Rankit higher on the back of all the Lemsip I'm buying. But this is your potential return zone on this particular pair. And again, it could be that resistance level, which kind of coincides with the 50-hour moving average and the top end of that channel, which has been sort of in vogue since the beginning, or about 10 or 12 days ago. So that is what we are possibly looking to see. And certainly the 110.50, 110.60, I would imagine will be the top end of it. I would change my mind if we break up through that 111 on this major moving average. Here is the 100-hour moving average, which, as you can see, has been a better cap to the euro dollar in the more recent past than, say, the 50 has been. So, you know, definitely the next potential resistance level if we do in fact break through that 110.50, but I would imagine that that will remain for the time being. And then we go to my favorite euro sterling, which is, since the last time, if I'm honest with you, has done not an awful lot. It's been a little bit static, which has been irritating to say the least, but I'm just going to delete some of these indicators, excuse me. Right. Well, we are, as you can see, potentially heading towards this 200 week moving average, which resides around the 79.30 or thereabouts. But there has been a huge big strength in this one. And of course, the weekly RSI starting to look a little bit overbought, even at these current levels. So, you know, it's up to Draghi as to what's going to happen here, and certainly he's going to come out with his dovish comments. But again, I'm inclined to think that, you know, maybe he's starting to lose his way a little bit. Maybe the markets are starting to not believe him to the same extent as they would have done back in 2011. So with that in mind, there is a potential risk for additional upside in the euro sterling pair. So certainly the 200-week moving average is a potential target. If we break up through that, then the top end of the channel, which is in around the 82, 83 marker, should be one to watch. And it coincides with the highs we would have seen on the 17th of March of last year. So, and it would have been a sort of an area of, you know, resistance support in the past as well. So it has been an important level, and it could be an important level once again. Moving on to the daily chart on that. And again, you can see the sort of strength of this particular trend on the daily chart, in that it has risen quite strongly, and as I've said before, it has executed this double bottom that we will ultimately be keeping an eye on because it does still need to extend to the textbook sort of move. God almighty, get rid of it. But here's your trend. And it's strong. It is very, very strong. But the only thing that you can actually see on this is that there is a certain amount of divergence on this, which could imply something of a pullback, maybe towards the 77.20 or thereabouts, which would then provide potentially a better entry point for a long trade. Majorly big bullish cross on the 50 through the 100 and the 200-day moving average, but certainly the fact that we've come back down from being overbought, should I say, into sort of more neutral territory but still rising implies a bit of sideways action before potentially the next push up. I do like to use the potentially word a fair bit just to be on the safe side, but the hourly chart is, in my view, quite an interesting one to watch. And as I've said before in the past, the fact that all three of the moving averages are below the current price action could mean that we have got a lot more upside to go. But at the moment, as you can probably see without me drawing any lines on it, this 78.40 level, excuse me, is a bit of a barrier to the upside, but it's definitely a target. And I would imagine that if we do actually kind of head up that way, and if it does actually press higher, there will be a lot of orders to perhaps take a long position through that. But there are also a fair few puts options up around these particular levels, so there could be a bit of choppiness before we make any real headway. And of course the fundamentals would at the moment point to a weaker euro if Draghi does what he says he's going to do. Let's move over to the old indices, because they've been a barrel of laughs recently, to be honest with you. All over the place, all over the place. As it stands, here's the FTSE 100 and doing its own thing, oscillating really around the 6,000 level, but not really able to kind of push higher than this 6,100 level, 6,130. And this is the weekly chart that we have here. We are just on the cusp of a bearish crossover on these weekly moving averages. You got the 50 coming from above, potentially going to cross down through the 200-day. So again, this confluence of moving averages will keep the bias on the downside for the time being. And the fact as well that it coincides with previous support levels does make that 6,400 level, 6,380 we'll say, a really big level for us to actually move through. So even if we do push higher, this is going to be it could be a target certainly, but this is going to be a major old barrier for any upside on the FTSE in the very near term. Add to that, the fact is we have dropped through some serious trends. So if I take my trend from here, and these are the lows over here, which are coming in around August 2011. And that also sort of culminates with a trend line resistance around the 64.50. So, you know, there is a lot more upside risk certainly and barrier than there is downside risk. That being said, this 64.80 level, 54.80 level has been hanging on for dear life, and of course that will need to break if we're going to see any sort of pushes down lower towards these lows that we would have seen in June of 2011. We're a while off that yet though, lads, don't worry too much. And of course the weaker sterling should in some respects keep the wolf from the door for the time being. Let's go in and do our Fibonacci's on this one, because I've just realized I've not done a Fibonacci in a while. And here is where we are. You can see that the 61.10 level coincides beautifully with the 100-day moving average there, and that has been tested and failed. So we are still making a series of lower highs and lower lows, which is obviously our real basic trend line, and a downtrend at that one. So as long as we remain below the 61.10, 61.30 level, then we are looking at the moment to sell the rallies. Now that will all change, as I said, if we break up through that 61.10, and then we will run into those heavy resistances that I would have pointed out on the weekly chart, which is the culmination of those moving averages and the long-term trend around here, around the 64.50, 6500 level. So where are we now? Okay, you can see that even this morning, today, we're just kind of stuck around the 6,000 mark, unable to make any real decision. RSI sort of, again, very lackluster, stuck in the middle, but you know, not downtrodden, and it's not over and done with yet. The hourly chart shows that we could have that little bit more upside in it. It has obviously, as I said, found it difficult to break through the 6065 this morning, but it is finding a degree of support at the culmination of these two moving averages around the 59.80 level. So where do we go from here? I'm going to take my Wonderful Fibonacci, and I suppose in some respects we look at this obviously to hold the 59.80 level to hold. If that does give way, then we've got the 59.50 followed by the 59.30ish level, and that would be a worrying thing because we have the potential double topping here on the FTSE 100. I say worrying, it could be an opportunity. So we'd look for it to come back down towards this 5900 level again, and if that does, we would then, I suppose, initially target the 200 period moving average, the 200 hour, but the textbook sort of version would be from 6063 to 5900. You're talking about 120 point move to the downside on the break through the 5900. So do keep an eye for that one. But as I've said, the trend is still up in the short term. And in fact, right now, it does look like a nice little buying potential, targeting the top end of the particular range around the 6063. But we're still waiting for some good news for that to actually happen. And maybe the US Open might actually provide that catalyst. And speaking of the US Open, let us crack on over here to the old Dow Jones and see how we've been getting on. And it's been getting on very well. In fact, some of the data coming out of the US has not been bad. I mean, you can't really say. I mean, we had some really good numbers there from some of the retail companies, which suggests that the consumer, much to the I suppose the chagrin of the likes of Zero Hedge, is not dead. People are still buying stuff. And again, on this weekly chart, you can see that while the market might have made this low, we're still above this 200-week moving average. So there is a potential for additional upside from here. That being said, there will always be the detractors, and that's where I come in. So here's your trend. And that does make me question how much real upside there could be. Now, what you will see is that this trend line, having been broken, is now potentially a bit of a resistance level. And I suppose you could say it coincides there with the 17,038, which is like, it seems a fair distance away from where we are, but ultimately it's not. I mean, the Dow Jones moving several hundred points in a day is not, as many of you will know, that big of a surprise. So there is a potential for us to go back up to this particular level here, around the 17071, possibly even higher. And the reason why I think that is potential, and be aware of the fact as well, if you're going to do this, you need to have limit orders in place. It's because we have this double bottom here on the daily chart, and I'm just going to remove this just to make clear. This double bottom, which found its base around here, around the 15,450 level, has actually broken through the 16,500 level. Now, I would like it to remain above the 16,500 level. We all would if you're long, obviously, but it does give you a potential move higher. And I'm just going to put the expansion on this. So if it breaks there, you're talking about it possibly going up as far as the 17,689. Now, I would say the 17,258 is probably a more reasonable sort of scenario here. Obviously, the 17,071 is one target, which is your 100-day moving average, 17,030. But certainly this 17,258 would coincide a little bit, I suppose, with that trend line from the actual weekly chart that we would have looked at. So watching that, RSI is still rising, and certainly there is a little bit of momentum behind this move. So we will see how that one works out. The hourly chart then, again, you can see a nice sort of trend to the upside. It's pretty beautiful, really. And that trend is in a lovely little sort of bullish channel. Now, what I will say is that yesterday, or certainly not yesterday, just over recently, just in the last morning on the futures, we have seen it sort of capped out around the 16,670-ish level, and certainly that could be a near-term target if this actual trend persists. It did go ever so slightly overbought at those particular levels, and in fact, if you look at this hourly chart and the hourly RSI, we actually had that certain amount of divergence, but it has found support at this 16,470-ish level and the 50-hour moving average, and of course your baseline on the actual channel here. So there is potential for additional upside here, but be conscious of the fact that this level here will need to be broken for those upside targets I would have mentioned on the longer term charts to be realized, and even those aren't a guarantee, as you well know. But it is a possibility, and as I said, anything can happen in these markets. And these bearish moves that we're seeing are, big swings. Yes, it's a bear market, but, ultimately the big swings higher in a bear market can be a lot more profitable than they might be in a bull market, because, you're being contrarian, and that can often give you a little bit of an edge over the uber bears and the perma bears that are out there. You got to trade what you see at the end of the day. And at this moment in time, we are seeing quite a bit more upside on the Dow Jones. Look where it's gone from the 11th of this month, from 15,500 to 16,500 and more in the last 12 days, 11 days. So, a lot to be gleaned here. But what I will say is that there have been a few gaps up and all along the way. So I'm not necessarily sure that this upside is going to continue, but that's where limit orders come in, and make sure if you are trading it to put those limit orders in, take those profits when they arise. Let us move over to the old gold space, because that is a request I'm having here. Okay, so now I note on Twitter, as I tend to do, that there are a few out there that are banging on about this golden cross on the gold chart, and that's great and all very well and all the rest of it. But these are the same people that have been bullish on gold since day dot. So putting on my weekly chart here, we have, as you can see, found good support of the 100-week moving average. That 1190 level is a big old level for the gold price. And as long as we're above that, there is a propensity for us to head up and possibly tackle that 1300 level. The fact that we've broken out of this big old long-term wedge is a very significant area for gold prices. Now, what it is dependent on is, one, risk appetite in the market, and two, whatever the Fed is going to do next. And we are never going to be sure about what the Fed is going to do next. So where have we been? That's your weekly chart. We've done that. We're well above the three moving averages. You've got the potential crossover here, the 50 through the 200, which is your golden cross, moving higher, which would in some respects tend to support that, but it's not a definite thing. That's for sure and for certain. So we watch it with cautious. But as I said, the 1190 is the level to watch on that one. In the near term, when it comes to trading this one, this is a potentially big explosive move ready to happen. And as I said before, the fact that we've got the three moving averages so close together here, there is something afoot. So drawing this on, this is your horizontal line. So is this. So this is your range at the moment, okay? And you also, as you can probably see, have an element of sort of like a trend higher as well in the short term. So you could actually say that we've got ourselves a potential continuation pattern, this narrowing range. And that, as we all know, anyone who's been trading this for a while, along with these three moving averages coming close together, is basically the recipe for a big old move. Now, whether that's going to be up or down is anybody's guess, but it's definitely going to be in the very near term. And we're looking for ultimately a breakthrough, the top end of this, which coincides, I suppose. I would be looking for the 1230-ish mark. And clearly a break through the 1240 would take us back to those highs that we saw about 12 days ago. But certainly this range is more than likely going to break the 1190/1240 range. Excuse me. And you've got to be ready for it. So that can be either through the use of orders, or to be actually watching it, or to actually get involved with stop losses along the way. But what will possibly be the big sort of catalyst for that is anybody's guess, but I would imagine it might be actually dollar related. And if we see any sort of pronounced sell-off in equity markets, then that could very well be the move that gold needs for it to get back up to those highs. But as I said, the weekly chart remains bullish above 1190. But range bound could be the case for the very near term. And that is it from me for the time being. I trust that everybody enjoyed it, gleaned something from it probably. But I've got a recording of this. So you're very welcome to watch it back if you wish. You'll be receiving it automatically in your email because you've registered for this. We'll be doing the same thing again this time next week, and you are very welcome to join me then. If you have any questions, you can send me an email, and I'll be happy to answer it. But have a very good day and happy trading. And of course, use stop losses. Take care. Thank you. Bye-bye.